All right, so let's talk a little bit about the Unit 16 post-lesson assessment on the adult course on types of financial market failures, speculation bubbles, asymmetric info, externalities, and riggings. So the first question that comes from this section was explain speculation in market bubbles and how they can cause market failures. So in a nutshell, assets are bought low and you sell them high. The profit is the margin in between. But if assets lose their value instead, then you're not sitting on profit, you're sitting on losses. And it's worse if it's a leverage deal, which we'll talk about in the next question. That creates what we call a bubble. People keep thinking that the price will rise, even when it's dropping in price. So you tend to buy more and more of this overpriced asset, and the price just continues to fall. Eventually, investors realize that this asset is not worth the high prices they're paying for it. For the fact that the price keeps coming down. There is a fall in demand. This ultimately leads to a greater fall in price, and this leads to a fall in asset value. The investors who have now invested in this panic because their assets are becoming worth less and less, so they sell their assets, which makes the prices fall even more. The end is that all the people who are sitting on the leveraged assets are now sitting on worthless leveraged assets and are also in a great deal of debt to their lenders. Now, if that asset holder is a bank, then the bank goes bust, and that leads to systemic risk where other banks can start falling. That's market failure. Explain a leverage deal. So it is essentially borrowing money from an investor in order to amplify the return on the deal. So say, for example, in a normal deal, you buy an asset and you sell it for a higher price, and you pocket the difference as the profit. In a leverage deal, you get a lender to lend you some money. You say that you're going to give them a certain percentage of profit that you make off of that money. And you add that money to your money that you are throwing in to buy an asset. This allows you to buy a much greater amount of that asset and then sell it for a much larger profit. Now, you've paid off your lender what they gave you, their principal, as well as a little bit of that interest, that much larger profit. And you get to pocket they get their profit, but then you get to pocket a much larger profit as a result. So let's take an example. Say you have $10 and you can sell the asset at $11. You've made a profit of $1. Now say that you ask for $990 from someone who's going to lend to you, and you tell them that you are going to give them that back, plus you're going to give them $10, for a total of $1,000 if they give you that $990 to work with. Now remember, you were able to take $10 and turn it into $11. So when you invest it, you are going to put that together with the $10 that you had. So that's $990 plus 10. You're investing $1,000 instead of $10. This means that if you were able to get $11 from $10, you're able to get $1,100 now for the amount that you invested. Now, you have to pay back your lender. So of that $1,100, you have to give them back $990 plus the $10 that you promised them, total $1,000, meaning that you're profiting and you're pocketing $100 instead of the $1 that you were pocketing before. So a leverage deal basically allows you to amplify your profits. Explain asymmetric information and how that causes market failure. Asymmetric information. So banks always know how much risk that they're taking. Regulators may not always, if it's being hidden from the bank. Governments may not always as well. This allows banks to take excessive risk on covertly. This can then lead to things like moral hazard, when the banks inevitably get bailed out and they feel as though they're too big to fail. Or it can lead to adverse selection when most buyers are those that the sellers would prefer not to sell to due to imperfect information. Explain negative externalities and how that causes market failure. When you get a bank bailout, the cost is borne by the taxpayer. This leads to the loss of individual savings, the loss of jobs and income, and the loss of growth. Now, this loss is completely ignored by the bankers. They take excessive risk, but they don't have to bear any of the burden if they get bailed out. As the bankers then start taking excessive risk, you have fewer purchasers and depositors and much more risky ones. And there is a greater likelihood that because these risks are excessive, that the banks will ultimately fail, causing a market failure. Explain market rigging and how that causes market failure. Well, in this case, the bankers, traders, or other intermediaries get together and they collude. The bankers collude with the regulators in order to manipulate market by doing price fixing to make huge profits at the expense of any agent that is not involved in the collusion.